Our next guest believes the Fed could actually lift rates through the summer. Richard Fisher is the former Dallas Fed president, a CNBC contributor. Richard, great to have you with us. So through the summer, you say 3 more rate hikes. In terms of total percentage move, what would that be in your view at this point?
Well, I think we're likely to have 2, Melissa. And the job is not done. It could be more, but the job's not done. The inflation numbers are still too robust. And I think Guy nailed it. It's not that there's no landing, it's just the landing has been postponed and maybe out there much further than anybody expects. The market so far has been wrong. The Fed is absolutely leading. They're doing what has to be done. I don't have any doubt that Jay Powell will stick with it and the committee will follow. And he's got a good lineup behind him. Obviously, Bullard's from a super tightening side. I'm not sure he carries an enormous amount of weight in the committee, but I'm pretty sure the committee is at least going to go at least another 2 quarters.
Mr.
And here's
Fisher,
the thing,
I think
Melissa.
the communication.
Guy, here's the thing, I think.
No, I'm sorry. I apologize.
No, never apologize to me. I should be apologizing to you, but here it is. We're living in a 4 to 5% world now. Get used to it. And I don't think people have quite adjusted to that. We had 14, 15 years of cost-free money. Everybody looks smart. And now we're going to find out who really is smart because you have opportunity costs here. The 1 year, look at where it's trading, right around 5. A little bit off today, but this is a very tough hurdle for people to meet who have gotten used to 0 interest rates. And remember, the Fed's also paring back the balance sheet, $85 billion a month in treasuries, no action in the mortgage backs. And we're running bigger deficits. And every country in the world, by the way, is ramping up defense spending and running their fiscal policy very hard. Who's going to buy all that paper? At what price? And that's what I love about this panel. You guys will figure it out before I do.
Well, I don't know if we're going to figure it out, but I'll tell you, we'll give it the old college try, as they say. And what I was going to say is, I happen to think, and I think if you watch, you know, I'm no fan of the central banks, specifically the Federal Reserve. Doesn't mean I don't dig you, because I do. But I just, you know, I think they've caused a lot of problems they're trying to solve right now. With that said, I think Jerome Powell's done an extraordinary job of communicating what they're doing. Here's my question to you. I don't think the Fed backstop is in the form of the S&P. If it is, it's sub 3,000. I think it's in the form of one of 2 things: the credit market cracking or unemployment going to 5%. Neither one of which, by the way, looks to happen anytime soon. What are your thoughts on that?
I think you're right, Guy. I could see the unemployment rate possibly going higher, but we're so far away from that right now. But your point about the credit market cracking, there is a Fed put. The Fed put occurs, as we saw most dramatically in 2008 and 9, if the credit market melts down, if we don't have counterparties that are willing to bid properly. But right now, the credit markets are pretty accommodating. Look at what's happening in terms of spreads. And it looks like the credit market is actually smoothly moving along. Some disturbance, but not much. If it seizes up, then the Fed has to act. And if you listen to Chairman Powell and you listen to others, they don't see that right now. I don't see it either.
So, Richard, just to underscore a point that you made earlier, because I got it wrong in terms of you seeing 3 hikes. You say 2 hikes, but you see 0.75%, correct? So, I mean, how should we think about that in terms of how long we stay at that rate?
Yeah, Melissa, I don't think they're going to cut this year. And I think they're going to hold to make sure that inflation is moving down to the 2% target. That target will not be abandoned, not for a temporary period. It's going to have to be strongly moving in that direction. And I could see the possibility of 3 more hikes, whether it's 2 or 3. I think they're going to hold through the rest of this year.
Okay. Richard, thanks a lot for your thoughts. Appreciate it. Always good to see you.
Oh, thank God for wearing a bright dress, because we all need bright thoughts right now. So thank you.
I try. Good to see you. Thank you.
Thanks a lot.
Richard Fisher.
Bye, guys.
The notion of hiking rates and keeping rates at that level for the rest of the year is definitely something the markets have not come to grips with, if that is the reality.
Yeah, so one of the things that we looked at all of this stuff through the lens of the markets, right? And so the idea, then, and Richard just said this, that, unemployment rate is not going up meaningfully so fast. We know that's like kind of the last piece of the puzzle here for the Fed that might cause them to kind of get a bit more easy. Nobody's rooting for that, obviously, okay? But the markets, when it comes to valuations and all the stuff that we've just talked about, and we talk about where a Fed put is and what would take them to do that, it's like some sort of credit event. Those are a whole host of things that wouldn't be great.
Not good for equities.
Not good for equities, not good for the economy, not good for anybody here. And so one of the things that I'm just really focused on when I use that term, I know you were really offended by that, Bono, garbage, it's like the worse we see, the more like moves we see like that, is the harder that if something does happen, the equity markets fall. The more people that were sucked in towards the end into the worst stuff, they get hurt the most. And I mean that. And so that's why I think like a step function of having the S&P come back, retest that 200 down there at 39.50. Right now we're at 49 or something. That's healthy. There's no fear in the market right now. And that's kind of what I'm thinking about. And I'm not wishing unemployment to go higher. I don't want the economy to fall. The economy seems pretty good right now. And rates higher for longer, though, has the potential to, I actually think, hurt the economy. And therefore, we could see just dislocations in the market that will hurt people.
Yeah, I mean, I don't think people are paying enough attention to it. I think good point all around. You start to look at these delinquencies and you look at credit card balances. I think the pro bull argument going throughout this whole situation is that if you look at the consumer, they still have these robust balance sheets. They still have however many months of savings. And you're starting to see that reverse itself at a time where rates are going higher. So you're going to see balances grow, not just because they're having to now meet. And you see that PPI reading, which is slowly going to leak down into CPI. Not only are they going to have to deal with the headline situation, but the rate at which those credit balances are growing are also higher. So just the debt service, right, the interest service that is needed just to keep that pari passu with where it was is now a lot more cumbersome. And we are starting to see some of these readings, and they seem to kind of just get pushed off to the side. Again, it hasn't been a fall off of a cliff, but things typically do happen in somewhat of a step function. You don't go from 60 to 0. This has been a hot economy. There has been, a lot of strength. The labor market has continued to be strong, but these cracks that we are seeing, to me, at least, shouldn't be ignored.
To me, there's a couple things, though, that are really important on the bright side. One is that the consumer has a job. And the consumer, we're talking about where the Fed is pinned because that job market's not going to change. I mean, Richard Fisher's a guy that sat in those meetings, and they're probably prognosticating how long it's going to take for the consumer to fall out of bed. I don't think they are. The second part of this is the retail investor, for better or worse, and I know we sometimes fear that that's the last kind of in a market. The retail flows have been enormous over the last 3 months. The retail investor is alive and well. So people wonder why the markets are continuing to do what they do. You have a job. The retail investor, despite the meme stock, I think set up again that it looks pretty ugly. People have jobs, and I think the sequencing of where this market is going. We're waiting for another earnings cycle or two before we're going to get through this.